Hey traders, welcome to this video. Will Sebastian here, pro multi-asset day trader. If you want to learn how to trade, just go underneath this video. Myself and another pro multi-asset day trader teach every single day live on Zoom, and we help everyone on DM and publicly in the public room as well. It's a great place to be if you want to get things right. So I'm going to cover the Japanese stock market. You can see the Nikkei 225 index, JPN225, major Japanese index. And there's some really good stuff you can learn from this, but mostly it's because a lot of people are looking at this index as something to potentially buy into and get out of. So I thought I'd cover the cases for that, what I would do with it and how I would do it. So what I would like to say, first of all, is that you pushed up to your all-time highs, and then you get this big swing to the downside. Okay, and that's when you really had all the carry trade sort of fears, basically an unwinding of monetary policy, how fast it was going to be, whether it was the right thing to do, the state of the Japanese economy. You also had worries about US recession, potential China recession, and safe haven inflows, and all kinds of market sentiment at that point. But what is really key is the fact that I labeled this as a long-term investor long zone, and that dropped from about 39k to about 30,450 or so, 30,500. Big drop there. Multi-thousand point drop took you to this area here. Now, it is absolutely no surprise. If you want trading to work, by the way, you've got to understand this. Ask yourself this. Do you think that it's a surprise that this candlewick just happened to stop in line with that one, and that one? Do you think that is a coincidence? Do you think it just picked that point? Okay, there's a reason why I labeled this a while back as a key long zone, and it's because it's reactive. It's because you bounced from there before. Trading is all about this. This is literally what trading is. These reference points are ones where you are going to be more probable to get a rebound than you are to fall through, because the support here is very ideal. It does not mean that you can't do this. Okay, if that candle had extended and you came to this level, it's not to say that cannot happen. It's not to say that this is an invincible sort of barrier, if you like, or some really concrete floor where the price can't drop through. It's not to say that whatsoever. It's just simply that if you wanted to buy anywhere along here, okay, then the places to do it where you have probability is going to be here, okay, and there. And that's why I mentioned those areas for long-term investor longs, because simply they have provided support before, and therefore that gives us probability in the future. If we were going to take a guess of wherever you had to bounce, you are just statistically going to be better off doing it where you've bounced before. That is simply how markets work. The rest of it is understanding risk management and sentiment. There's three key points: price action, risk management, and sentiment, or technical analysis, risk analysis, and sentiment analysis. Those three things together are what really allows someone to manage a portfolio effectively over time. So you had market scares, essentially big drop, worries for the Japanese stock market, as you can see, and various drops on other equity markets, and then an immediate rebound because you get sudden risk on. Investors say, okay, well, that was nothing to worry about, and you come straight back up. And where the Japanese stock market sits is pre-earnings, some key domestic earnings, and also just before an election, I believe on the 27th of October. So there's this real stall here, and it's similar on the FTSE, for example, UK stock market. You have a real stall before you get this budget to come out and say, this, that, and the other. And traders just don't want to know at the moment. So obviously, therefore, you're either going to get real risk off within this market and a big pull down, okay? And perhaps you might get something like this, all right? So you might only get thus far, okay? Or you may see it to the upside to that high, potentially then beyond, okay? The upside is going to come on renewed optimism, okay? Risk on, like I said, the categories really you want to look at for risk markets like this are risk on and risk off, okay? Risk on would take us higher, risk off would probably take us lower, but you can still see there is a very tentative drift to the upside on this particular market. You can see you're getting higher lows and higher highs still. So there's slight optimism and you are still climbing. So we can take from that quite a lot, because if you get to here, like you are now, it's no surprise really you're starting to stall. And you're starting to stall because there is slight optimism. Whether you get up here or not is going to be very debatable, but it will likely come around as you see some new market sentiment inflows. So for that reason, if you wanted to short this stock market, I would probably just hold off at the moment. You've already got a bit of a fall, so naturally you're selling into support. Okay, you can see that to this side, but you can also see a big amalgamation of those MAs, which really you don't want to be selling into. If you're going to short it, I would probably just do it on a real push up to highs, okay, because you're still tentatively rising on a market recovery. If you wanted to buy this particular market, also, I would say you need a good thumping lower. Probably at least to here to start with, although I do believe this is slightly weak as a level. But if you're an investor, again, I would just wait for something significant. Okay, something significant, perhaps being that far again onto your 200 MA. You can see very significantly that instead of the 40 MA now, you come right along this 200 MA. And that's why it's such a key investor long zone. And that's why you would have had many traders pile in there and do very well indeed. You may see a stall here as well. But since this candle which stretched right through, it doesn't necessarily invalidate this level I'm referring to, okay, all around here. Probably use an eclipse of that. It doesn't invalidate this, but it does just cause you to question why markets didn't stop there. So you really have three levels, the lowest being absolutely the most significant. It might be rare that you get there, okay, but if you want to buy this, if you're going to buy here, it's got to be very light. If you're going to buy there, for me, it's got to be very light. If it gets down here again, then I would buy slightly more than the other times. I think these levels are a little bit more vulnerable compared to this one because it's so significant. That would be a good drop like it was, coming on 20, 25, 30%. Like I said, anything back to the highs, then I would be encouraged to short. But if you are going to short, just remember that these highs are not the be all and end all. You did have a drop there, and then there, and some people might call this a head and shoulders effectively if you fell again from here. But mostly I'm not really a pattern trader as such. I wouldn't short it because it's formed a head and shoulders or a backwards monkey drop or whatever you would call it. I'm just doing it because the price is high. But if I was going to do that, then I would do it in the full knowledge that I could break above this high and keep going higher, particularly on a strong risk-on environment. If you do have a result in the election, which is highly anticipated, I believe it's the Lib Dems or some Liberal Party with 223 seats projected or something like that. And, for some reason their economic agenda is stronger or the earnings out of Japan are very strong, then you can absolutely see this higher. So you cannot say that, I'm going to short at 41,250 points. And that's as far as the index is going to go, just because I said so. It just doesn't work like that whatsoever. And therefore, I just wouldn't do it. I would always short an index with a good gap to the next short above those highs, because you just don't know when it's going to stop. You don't know particularly how far this can actually go. So number one, on the risk side, again, I would make it very, very small. And number two, I would space out those entries. It's the same for any index or gold, indeed. Gold making higher highs, there's no resistance to the left-hand side because it's never gone so high. So therefore, it's no man's land on where it will go. The only other thing you can do is wait until a move up here and then wait for a sentiment change. And then, of course, you can enter the market as need be. If you look along here, you can see you had a bit of a sentiment change there. You could have shorted, little pops here. You could have shorted that. Okay, and then had the drop because the sentiment has changed. At this point, if you're going to short or you're going to short at those highs, the sentiment won't have changed yet, and therefore you'll be shorting into momentum, so you need to be very careful. So that's how I'd go about on this index. Hope that helps. Don't forget, if you want to cover assets like this with those 3 key factors, technical or price action analysis, sentiment analysis or fundamental analysis, and risk management analysis, essentially organizing your portfolio in a very concrete way, then go underneath and join people doing it every day, ourselves and all our pro members as well. So thanks for watching. See you in the next one.